Okay, there we go. We're live. All right. It is June 10th. It is late, and we are going to do our best to get through this case study as quickly as possible and answer the questions the best we can. So, with that being said, I think let's just dive right into the case.
Yeah, okay.
So, first question. Um,
Are we
review the summary. Okay. What?
I was gonna say, are we doing which team had the highest pre-money?
Mm-hmm. Yeah, which
Lowest?
team had the highest pre-money value, lowest? Which did your team? Where did your team fall? Um, so I got that Historia. Historia had the highest pre-money valuation of 10 million, and Prosper had the lowest of 7.5. Um, the the venture company that I would have gone with would have been DPV, the DuPage Ventures. Um, as far as pre-money, um, they said it was right between three. What is it? $3 to $10 million,
Yeah.
and that's dependent on if they have a forecast for $50 million within 5 years.
Yeah.
That's what I got for that one. What did you get?
So I read that one differently.
Okay.
Like, from my understanding, I think it said somewhere that like team wise, like obviously we don't have like a ton of people, it's just you and I, or you and me.
Mm-hmm.
So like it was supposed to be like teams of like the DPV team and then like the founders team, like doing like supporting their valuations and doing like a mock
Okay.
negotiation
Okay.
thing. That's what I thought it was.
Okay. Um, did you want to do it that way then?
Um, we can. I mean, it doesn't matter if that's how you did it, but I didn't know. That's why I kept asking how you got the valuation
Okay.
from the DP, like how you did it from the venture capitalist point, like their evaluation.
Mm-hmm. Um, yeah, like I said, I don't have the exact
Mm-hmm.
pre-money valuation calculated, but just from everything else, like from all the other pros and cons,
Mm-hmm.
looking at them, for me, DuPage Ventures, I chose them. I would like if I was Munich, that would be pick.
Mm-hmm.
What about yourself?
No, yeah, I said that either way that they should go with DPV for
Okay.
like another point, because then it goes back into like number two, whatever, choose like what their goals are for.
Yeah. Um,
Because so what I put for like the like what the goals were for DPV, like to get out of this negotiation, was that they were just um they seemed pretty fair, to be honest. They wanted to figure out what investment would help them starting out that was both fair for both parties. You know, they kind of wanted to test the waters and invest some and see where it goes. Um, they wanted to like provide enough, I guess, financial support to have them continue forward. but not enough, like not too much to where there was a issue of equity right up front.
Okay. And I got for DPV that obviously the IRR was 25%.
Mm-hmm.
But then also the goal, well, really, they wanted to be able to help them with capital and to help them raise even up to 10 million, even if it was just a Series B. If that 10 million came in a Series B financing, but what they wanted to see was for the company to reach 50 million in 5 years, and then have an IR of 25%, so they're making 25% of that 50 million. I think that's yeah, I think that's right. And then as for the board seat, in the case, it said that it offered it was their associate to sit in on the board as a non-voting member.
So they wanted someone to just be a part of the meetings, but not really have just kind
of. Looks like we lost her. Hold on here. Are you back? Are you there? I think we're back on. Hello? Can you hear me?
You still there?
Yeah, okay. There you go. I lost you there for a minute. All right. Are you good to go?
Yeah, sorry. It might just be my Wi-Fi that's been like
That's all right. That's fine.
Yeah, but sorry, did you hear that last part that I said?
Was it about the non-voting member on the board?
Yeah.
Yeah.
Okay. So, yeah.
So how important is the deal to DPV? What'd you get for that?
I didn't think it was like a once in a lifetime opportunity for them, but I thought it was a pretty good investment on their the sales. Obviously their sales were going up, and they have it in already because they've been talking to both of them since the beginning.
Mm-hmm.
So I feel like it would be a pretty good deal. That if they took it on, they'd make it pretty good.
Yeah, they'd at least make some sort of profit. It might, the company may not reach the 50 million in 5 years, but they'll still reach a pretty good profit.
Yeah.
So, as far as Mumate, sorry, I pronounced it wrong. How do you pronounce it? It's a Mumate?
I think it's Mumate. Yeah.
Mumate, yeah. So as far as it fitting the investment focus, I think it fit just perfect because the DPV partner, Ed Rodriguez, said that he had, quote, deep experience investing in niche, high-end brands. Or did I say that right? Niche?
Yeah, niche.
Okay, niche. Niche high-end brands, including some beverage companies.
Yeah. And even the other dude, what's his name? Cantor. He had experience working for companies like Nesto. Or Nestle or whatever. Nestle. Wow, I don't even know
Nestle.
how I said that. Wow.
It's all right. It's okay.
Yeah, but he had experience working with like Nestle and like beverages. Like they had really good experience working with this
Yeah.
type of industry. So they knew what they were doing.
Mhm.
Yeah.
All right. As far as seeing things the same way, or were you focused on other interests? The order of importance as far as deal terms, pre-money valuation, board composition, option pool. Um, I know we already went over this before, but just for recording purposes, if you want to go ahead and state your number 1 to number 4.
Oh yeah. Well, actually, I ended up changing mine, but I put that. Yeah, deal terms, like you said, deal terms number 1, just because it is like a summary overall of like what the terms are actually going to be, and then board composition as a second, because that lays out, who, like basically who's in charge of what, like the decision wise, who will be able to make decisions or not, who has more of the power to make decisions, kind of thing. And then third, pre-money value, and then fourth, option pool.
Cool beans. Cool beans. Yeah, I mean, like I was saying before, I'd be, ow, stupid cat. Um,
Shoot.
so, yeah, no, as far as like a board composition, I'd just be really ticked off if I was a founder of a company and then all of a sudden they're like, so actually you don't fit the bill, so we're gonna go replace you.
Yeah.
I'd be really ticked off. But it happens all the time. Let's see here. So, um, what are the pros and cons of Astoria Prosper and seeking capital from angels? Well, I guess we could go ahead and answer. How did the Astoria and Prosper term sheet affect your negotiation strategy? As far as me, um, like just writing down the pros and cons,
Mm-hmm.
I was able to, figure out from that. Like as far as the negotiations go, well, I don't know. I guess I'll answer that in question 5. Was it question 5 or sorry, question 6? If you want to go ahead and answer that now, you can.
No, we can wait till question.
Because I think that's really part of question 6. I don't know. It seems that way to me.
Yeah.
Um, so as far as what are the pros and cons of Astoria Prosper and seeking capital from angels? What you got?
I actually didn't see that question, to be honest. So
Oh, that's fine.
yeah.
That's
So you
fine.
can go ahead first, and
So as far as Astoria, the only pros that they had was that they had the highest pre-money valuation of 10 million
mm-hmm.
and founder share vesting of 33% on closing. The cons to the company was Taylor would not even be considered as a co-founder, even though she was.
Mm-hmm.
And then it had a large option pool of 17.5% diluted shares. To me, I took that as a negative just because, and it's probably not a negative, but from a founder standpoint, it just means you have less equity, and I mean, it gives your employees more equity, which is good for them, I guess. So really, that should be a priority. And then as far as cons, oh, the whole idea of dispersing in tranches,
Mm-hmm.
tranches, I think is the word. Um, So they want to disperse the money. And the first one would be 1.25 million, which I believe in the case they said they needed was like 2 point.
Wait, how did you get the 2.5 million?
The 2.5 million.
Mm-hmm.
What did I connect the 2.5? Did I say 2.5 million for dispersing the tranches?
Mm-hmm.
Okay, so that was um, in the confidential for Maxwell thing, the link that he had put up.
Mm-hmm.
Um, so that's where I got that from. Oh, let's see here. So okay, so it was the funds were to be dispersed in two 1.25 million tranches. With Astoria acquiring an equal number of shares upon disbursement of each tranche. However, 1.25 doesn't quite satisfy the need that they have. It was because they needed, yeah, the projections show that the company required 2.5 million of additional investment before achieving cash flow break even, and that's without even um, that's without expanding into the doing some major expansion into the East Coast, I
Mm-hmm.
believe. Um, and so they need the 2.5 million at least. Um, that's just to get to break even. That's not even to expand the company.
Mm-hmm.
Um, so yeah, to me, I took that as a con. The um, the the dispersing it 1.25 million and then 1.25 million um, over a 12-month period. Um, so that was a negative. And then also, if the milestones are not met by year end 2013, Astoria is not obliged to fund the second tranche. Or tranche,
Oh,
whatever it's
so
called.
yeah, if they didn't make that money back up, then they would have
Yeah.
just like canceled the whole,
Mhm.
backed out of everything.
And then also, a con I saw was unvested shares subject to buyback at fair market value. Um, so any of the unvested shares could be bought back once the IPO was created. So the founders would be losing more. Um, let's see here. And then lastly, the reputation of Astoria um, was bad. They're struggling to raise its next fund. The firm was also known to replace the founders. Um, let's see here. Yeah, so that's what I've got for cons. And then as for Prosper Fund Venture Company, the let's see here. The pro was that um, the two co-founders would be the two co-founders. They wouldn't be dropping Taylor.
Mm-hmm.
She would stay on. Um, and then the optional pool was smaller.
Mm-hmm.
Um, excuse me. I guess now looking at it, that would be more of a con. Um, and then as for pro, the company itself was on track um, to earn attractive returns for limited partners. Um, and then the cons were I guess the 12.5% option pool, the unvested shares subject to buyback at fair market value, and then the board member lacked packaged goods experience, but he did have a strong track record in consumer tech investing. So those are my pros and cons. And then for DuPage Ventures, pros was that they had the same values that Mumite had. The company, the member of the board that would be representing DPV for pro, this is a pro, is that they would be a non-voting member. So they're just, Mumite has complete autonomy over the company. And then lastly, they were a top performer since its founding. And then actually, then one more thing, the partner who's working with this deal has deep experience in niche high-end brands. So he's got really good experience. And then the con was the pre-money valuation probably isn't going to be the highest. And then in addition, it comes with the condition that the company has to reach 50 million in over 5 years in order to continue the series rounds. So they have to be on track at least, was my understanding.
Okay.
So that's my answer to question 4.
Not more than me, because I didn't even look at that one.
Okay. You want to go ahead and move on to question 5?
Yeah.
Okay.
Is that
how did? Oh yeah, this is the one that we didn't quite understand how to do. So, yeah.
What share of equity with that? Yeah, we didn't really understand how to. We didn't get a video or anything either, huh? Of how to. Okay.
No, the biggest thing that was confusing was it. I didn't see a way of how to calculate the value for DuPage Ventures. I didn't see how there was a way to do that. So, anyways. Moving on to question 6. What have you learned about bargaining tactics? Should Mumite disclose that they have other offers? Do hardball tactics make sense in a negotiation like this?
For that one, I just said that it really just depends on like their timing, like both from like the founder side, like if they really wanted to disclose, like it just depends on like how far along in the negotiations it is and like how it's going, because if it's going good and they get like they feel fair, like both parties feel fair and the founders feel like they got what they needed and wanted, I don't think it is necessary for them and like just to feel like they can have an extra edge, because like you were saying earlier, like they could disclose it and it might just backfire on them.
So. Yeah. Well, it could go. To me, it seemed like it'd more likely backfire, but that's just. I'm not one to take a whole lot of risk, and I'm not a a salesman talker like my dad is. He would probably say, "Why not? Might as well go ahead and do it," because he would know how to do it. But as for me, me, I do not have the skill to do that. I don't have the skill to talk someone um, into that. So if it was me, no, I I would just say it's not necessary, and just leave it at what the deal is. So
Yeah.
all right. Um,
Key takeaways. Terms allocate economic and control rights. Is that just talking about, like, again, going back to like the board composition and things
I
like
think
that?
so. Yeah, the board composition. So what's your takeaway on that?
I think it actually is. Like, that's why I was like, oh, whenever you're talking about how you would put that in your order of importance to number two, I think it is really important in order. Like, obviously, like, you don't want to have issues of equity right up front. So it's better to like come to an understanding of how, coming from like the founder side, it's better to have an understanding of like how you want your company to run, or like how, because if I owned a company, I'd be really particular about ownership or about letting, who would I let in, kind of thing, in order to like shareholders wise and like investors wise, because it goes back to
Hmm.
like the founders and CEOs know the company and the vision they want for their company. And so if somebody
Mhm.
comes in and has a completely different idea than then like ownership and control rights are gonna, like, you're gonna butt heads on that.
Yep, I agree with you 100%.
It goes conflicting priorities of investors and entrepreneurs and upside and downside scenarios. Was your takeaway on that one?
Um, hmm. I mean, I didn't. As far as upside scenarios, the conflicting policies or priorities. Sorry, the conflicting priorities of investors and entrepreneurs in upside scenario would be, um, going back to those. You're, important to you. Um, the the board member composition. Um, let's see here. Um, it, the upside to that is allowing the founders to stay. Side scenario for that would be trying to replace the founders, and trying to change the vision and the direction of the company. Um, and then for investors wise, um, investors obviously they're just there to help the company grow, and they're supposed to be there to not only help the company grow, but also to help the company original vision, the founder's original vision of the company. Um, so I think in any upside scenario, an investor is going to support um, what you hold to be most important, because that's what obviously is making your company successful. Um, and then as far as downside scenarios for investors, that, bringing in a new person there could be a possibility that they could have something that the company needs that it doesn't have already, dramatically increase profit and increase earnings, or decrease expenses and increase earnings, or both. So it's definitely a compromising game, a game of compromise. So,
Yeah.
yeah. Terms have a price. Any thoughts about that?
I think like in any negotiation, I think and like everything has a price. Like, obviously that goes back to like you before you go into any negotiation, you have to prioritize what you want. Kind of thing, like
Mm-hmm.
what is more important to you and what you're willing to give up, less of in order to have more of something else kind of thing.
Mm-hmm.
So that's just what I said on that one. That everything has
Okay.
a price. What are you willing to give up to get more of?
Okay.
Simple but sweet. Sweet and simple.
Yeah. I didn't have anything for VC valuation techniques. Did you have anything for that?
I didn't have anything just because this case was kind of weird. I didn't really understand like anything from like the investors side because it was
Yeah.
all from like the founders. Like it gave like what their idea was, what kind of like how they went about to calculate their own value, and it was more from like their side. So I don't really know what. I don't know. Did you
Yeah.
have anything? I didn't really have anything for that.
No. Obviously, going to be dependent on how your company is doing profit and earnings wise and expenses wise,
Mm-hmm.
and then what the investor can do, and also the potential for the company. I think those are going to be the three main things that determine your valuation, and then it your business model, I think, is what may help determine the technique that you use for your valuation.
Yeah.
So I'd say it's those four things. Then it's your business model, um, your earnings and your revenues, and then your what was the other thing? Your potential, the potential for the company, the potential for the product to grow. So,
Yeah.
yeah. All right.
Go team.
Well, I believe those are all the questions, right?
I think so.
Okay. Cool beans. Well, I'm gonna go ahead then and stop the recording
Okay.
and call it good.